This presentation helps entrepreneurs understand how to win an audience with a venture investor. Preparing the business plan and presenting to investors are addressed in other lectures. The first thing to recognize is that investors are specialists. Some investors lead the round, which means they negotiate with management, set the terms, conduct due diligence, and subsequently one of their partners usually joins the company's board of directors. Other investors follow the lead, providing additional funding but taking a more passive approach. Lead investors often slice up the financing and syndicate the opportunity to one or a handful of follow-on investors. Until you have a lead investor in place, there's little point approaching follow-on investors. Almost all investors focus on a certain stage of company and a specific round of funding. So there's little point in approaching an expansion stage investor with a seed stage opportunity. The same is true with technology sectors. Don't approach a biotech investor if you're in the telecommunications sector. Most venture capital partners take a board seat in the company and attend board meetings. Many are reluctant to travel too far for the board meetings, so they invest in local companies, those within an easy drive from the VC's office. So finding funds within your geographical region will help increase your chances of finding a good match. Investors receive lots of business plan proposals from budding entrepreneurs. Generally, they invest in less than 1% of the plans they receive. More than 99% of the business plans sent to venture investors are rejected. So when entering this process, you should prepare for rejection. It's not personal, it's just inherent in the process. Many investors admit that they don't even get to read the bulk of the plans they receive. However, they do take a look at the opportunities sent to them by other investors, their lawyers, advisors, and individuals they trust and respect. It's not a good idea to approach every investor you can find. Venture investors are specialists, and you need to find funds and partners in your geographical area that focus on your type of technology and your stage of company. There are, of course, online resources to help you find investors today. Databases of investors are available and provide the opportunity to narrow your search to certain geographical areas, technologies, and types of investments made. The Aztecs Knowledge Base provides a comprehensive directory of over 3,000 investment funds worldwide. Once you find an investor matching your opportunity, the next stage is to study their website to identify the partners focused on your field, the portfolio companies they've invested in so far, the firm's philosophy, and all the information you can gather to help you understand how this fund operates. Gaining an introduction from your lawyer, accountant, advisor, or a mutual contact can be invaluable if you're going to grab the investor's attention and have them read your plan. Targeting investors that match your investment opportunity, approaching them through the appropriate partner through a personal introduction, is not a surefire way of winning an audience, but it can keep the rejection quotient to a minimum. Don't select an investor for your target list without researching the partner's background, their portfolio of existing investments, and criteria showing there's a good match with your opportunity. As for the number of investors to place on your target list, you're ideally looking for something like 40 to 60 prospects. The way you arrange your target list of investors can have an impact on your success in winning their attention. As you'd expect, it's difficult to get an investor excited about an opportunity that's been heavily shopped around and rejected by all his or her competitors. The best approach is to rank all the investors on your target list, put the best prospects at the top, and approach them first. Preparation is essential. Before you approach investors, you're going to need a number of materials. The elevator pitch is a short, snappy description of your company and the investment opportunity. The idea is that it could be delivered in response to a question from a venture investor you run into in an elevator who asks you, "So what do you do and why should I care?" Random meetings with investors in elevators is unlikely, but you will probably find yourself delivering the elevator pitch repeatedly in voicemail messages that you leave for investors. We'll talk about the elevator pitch a little more in the next slide. You're going to need a target investor list, hopefully resulting from research you've carried out online, identifying the investors with the best fit. As many introductions are made via email today, an email teaser is the equivalent of an elevator pitch written into an email message. The executive summary is a 2 to 4 page synopsis of the entire business plan and the investment opportunity. The slideshow is a 15 to 20 slide presentation that can be made in a 40-minute time slot. Customer testimonials are always valuable to show the market acceptance and support for your product and technology. It's validation of the idea and a demonstration of momentum that you're generating in the marketplace. A contact management system is very useful to help you track who you've called, when you've called them, and where you stand with each of your investor prospects. In the elevator pitch, you have about 60 seconds, about 100 words, to describe the business and opportunity in a compelling and impressive way. To assess if there's a fit, the investor is going to want to know what stage of company you are, the market sector in which you operate, the product positioning, and competitive advantage. You'll want to take the opportunity to highlight the momentum you're generating and identify the type of investor you're looking for. As always, momentum in the form of growing sales, endorsements and testimonials can generate excitement and grab attention. The most effective method of approaching an investor is via a trusted intermediary, ideally your lawyer, accountant, or mutual contact. After the introduction, often made via email today, you could follow up by sending an email with the executive summary of your business plan. Give the investor a couple of days to read the material, then make your own follow-up call by telephone. The objective of this call is not to explain the whole business opportunity, but to set up an opportunity for a face-to-face meeting and presentation. As most entrepreneurs don't want to spend their careers chasing investors, they often look to outside professionals for assistance when raising funds. A professional fundraiser can provide valuable assistance in preparing the business plans and materials. They can make introductions to investors and guide the company through the presentations and negotiation of terms. However, in the US and many other countries, this is a highly regulated business. Individuals and organizations offering these services must carry dealer-broker licenses. The SEC and the National Association of Securities Dealers are heavily involved in regulating this activity and set high standards for dealer brokers to reach. The other issue here is that venture investors are often reluctant to have a percentage of their funds paid in commissions or success fees to intermediaries. As a result of the licensing regulations and the investors' perspectives, hiring a professional fundraiser on a contingency success fee arrangement is not a viable option for many startup companies. Hiring expert advice on a consultancy basis may be a better option, especially if the consultants defer payments until after the company has closed a round and raised funding. Investors are human too. They react to your energy and they're attracted by an upbeat team that's making progress. Investors gauge and are often highly influenced by the reactions of others. Excitement is contagious. If an investor feels that others are excited by the opportunity, This will often spur their own enthusiasm. They also like to be wanted. They like to feel that you're not just after them for their money, but you want them involved in your company because you respect them and believe they can add real value beyond providing cash. Investors are also competitive and they like to win, especially if this means pushing other investors out of the way to take the prize for themselves. Take care when approaching investors. The old adage that you only get one chance to make a first impression is certainly true. If you're leaving a voicemail message, make it short and snappy, and don't leave more than one. It's pushy to leave the same message several times. If you're expecting to leave a voicemail message and the investor picks up the phone, you should be prepared to deliver your elevator pitch and speak with them directly. Show respect for the investor's time. Don't keep them on the phone longer than is necessary to deliver your pitch and set up an opportunity for a face-to-face meeting. If the investor passes and makes it clear they will take these discussions no further, you can ask them for advice and thank them for their time, but be prepared to move on. Don't expect that a repeat of the pitch or more detailed technical explanation will help your cause. Your investment opportunity may not be an ideal fit with this investor, but they may know other funds with an interest in your type of investment. Once they've passed on the opportunity of investing in your startup, your objective switches from setting up a face-to-face meeting to having this investor make an introduction to another, more suitable investor. Some of these points may seem obvious, but they are often ignored by budding entrepreneurs.